Okay. So some of you may know me. Some of you may have joined some of my prior webinars or our client that I've met with, or you may have just seen me at a seminar and so on. But my name is Mark O'Brien. I am a estate administration attorney. A little bit of my background. I've been here at Kopenbarger for about 3 years. Previously to that, I worked at a firm only about 4 miles away from Kopenbarger, still in Orange County for about 7 years. And then prior to that, I worked in law firms in downtown LA, Beverly Hills, the West Side, and San Fernando Valley. So kind of all throughout Southern Orange County. All of my practice areas have been the same start to finish: estate planning, estate administration, which is probates, trust admins, conservatorships, guardianships, some probate and trust litigation, tax planning, and then along with that, business succession planning and wealth transfer planning. A lot of the same correlating and corresponding areas that all kind of come together here. Just disclosure page. This is all for educational purposes. It is not going to be legal advice, nor is it accounting or tax advice. It's just general guidance. Um, if you have questions, please throw them in the chat. Because even if I don't get to them, we have other individuals in our market department who are taking screenshots and they will send them to me afterwards. And if I can get you an answer, I absolutely will. If it's too nuanced, we'll say, hey, please schedule a meeting. You'll probably need a more in-depth analysis and discussion. But like I said, feel free to throw those questions in the chat. I probably will likely not get to them during the webinar, but afterwards I do sit down and go through them. And sometimes there's some pretty poignant questions that can be answered relatively easily. So please feel free to do that. So these are this slide shows our attorneys. As you can see, if you've been a long-term uh, client for Kopenbarger, we have a couple of new faces and a couple of new attorneys. Um, I believe Mark Krause has been here for quite some time, so a lot of you have met with him. Kevin Vanderbroek is a newer attorney with our firm. He is not a new attorney; he's just new with our firm. He's going to be handling a lot of our tax planning and a lot of our advanced planning. And then we recently brought on two new estate administration attorneys, Gregory Frankel and Matthew Schauer, both 10 plus year attorneys, heavy focus in probate and trust litigation. Now they're going to be helping us and assisting us significantly in our estate administration department. So just a nice picture of all the attorneys here. Skip the slide. This is a nice picture of our staff. So, it's not just the attorneys here. We have a lot of paralegals, a lot of legal assistants, a lot of marketing and accounting, all that make up who Kopenbarger is. Anyone who's taken my webinars in the past, I did not get the memo, and I really wish I did every time I see this, that everyone was going to be wearing a dark suit. Some of our offices, like I said, I'm here located in the South Coast Metro, but we do have offices in San Jose, Temecula, Pasadena, Laguna, and we can, be able to support your needs in a plethora of locations. Okay, now that we're gone through all of the opening remarks, now the meat and potatoes of today's agenda. Okay, so these are the five main aspects we're going to be covering today. Final stages of a trust administration, avoiding mistakes, or at least lowering the likelihood of mistakes and or contentious problems with beneficiaries or other third parties. Final timing. What are the appropriate procedures and timing expectations? That way you're setting appropriate boundaries with the beneficiaries. And a final wrap up, and then closing the trust. What does that actually mean? When can you say this trust administration is done? And what that looks like, and some things to be aware of, and things that can increase the likelihood of a more expedited administration, and also be more confident when you say you've closed the trust that it is actually done. Because there are numerous times when I've met with people who handle these things on their own, or they went to another law firm and they said, "Look, I did A, B, and C. I'm done." And then my conversation is, "Well, there's also D, E, F, G, H, and you also have to be aware of M and P and U." And they were not advised of that. So we'll kind of go through some of those things. So the first aspect is final stages, right? What has happened? So this is really the third and final installment of what I will call, from a 20,000 foot bird eye view, three phases of a trust administration. Okay, so the first phase, generally a really wide, ambiguous term, is, I'll just say, the notice phase. Okay. Second phase is really the inventory phase. And then the third phase is moving towards final distribution. So you can see here, these are all the things that have happened to get to this third and final stage. Okay. So the initial notices were completed and sent to beneficiaries and agencies. So those are the notices to the county recorder, county assessor. You've sent the statutory notices to the heirs at law, the beneficiaries. You've sent notice to the the California Department of Healthcare Services. You've sent notice to the IRS. You've sent notice to the Franchise Tax Board. You've sent notice to any creditors, and the list goes on. Okay, and then as a part of that notice phase, you're also doing that second phase, which is the inventory phase, and that's where you're marshaling the assets. Right. And by marshaling, I mean you're going out and finding them, you're gaining control to them, and then you're consolidating when appropriate. Or if there are non-trust assets, you're also dealing with those, right? If there's retirement plans, IRAs, 401ks, pensions, life insurance, annuities, and those have named beneficiaries, right? You're giving them all the documents, you're filling out the claim paperwork, and dealing with the distribution of those. Alongside that, right, you're paying the debts and obligations. They've been identified, they've been secured, and they've been handled. And handled can mean complete payment, partial payment, a negotiated settlement, or complete rejection, right? And you've walked through the rejection period and it's been resolved, okay? And once you've done all of those, and I know that sounds like a lot and it is a lot. If any of you have served as a trustee for any of your loved ones' affairs, it's quite a lot of work. But once you have completed, right, all of those tasks, and you've really finished phase one and phase two, now it shifts to the closing tasks and completing all of the final responsibilities and doing it in a way that protects you as trustee and thereby protects the trust itself. So kind of final stages continued here. The details matter, right? Decisions made now influence outcomes for trustees and beneficiaries. Tax consequences may arise. Errors cause delays or disputes, and rushed actions increase exposure. And I'll kind of go backwards here, bottom up. Rushed actions increase exposure. A lot of times people go, okay, these two phases are done. I'm ready to make distributions. Beneficiaries are bothering me and poking me and asking when this is going to happen, and I need to get them funds now. And the answer to that is no, you shouldn't be doing that. Why? Because you've done all of these actions, but you have not sought approval from the beneficiaries. No one has signed a release saying, hey, I agree and consent to all of your actions, and I relieve you of liability. No one has signed the waivers of account. And if you don't have signed waivers of account, you can't move forward unless you have to provide a formal accounting, whether that's a formal accounting outside of court or within the court. Again, you're increasing your exposure just to appease the beneficiary, and that is not a good thing. Now, I know that sometimes the trustee has to take actions that the beneficiaries are not going to like, and that's just a part of this process. But you have to make sure you're not rushing things. That doesn't mean you can't make preliminary distributions, right? That doesn't mean you can't disperse some funds so that the beneficiaries, if they need it for their own support or care, that they're doing that, that's fine. But again, you're walking that through the attorney and they're guiding you based on your circumstances to make sure you're not doing anything that's going to hurt you in the end. Further, tax consequences, right? If you sold a bunch of securities or real estate, you need to make sure you're holding back the appropriate reserve for the final trust income tax returns, right? And if you don't hold back the appropriate reserve and you don't file that trust income tax return and the IRS or the state of California ever audits you, then you're going to have a problem, right? Because you've already released all of the funds, but now you're getting this tax arrears demand letter from the IRS. And let's say you owe $20,000, who's responsible? You as the trustee, right? And now you have to go claw back funds from the beneficiaries a year, 2, 3, 4 years later, and good luck trying to do that, right? So coming up with the appropriate reserve, making sure there are no tax consequences, or conversely, consulting with the attorney and making sure that you're maximizing tax benefits, right? By making distributions at appropriate times and in appropriate amounts and filing the appropriate documents, there may be tax reduction strategies that could be implicated. So just making sure that you're doing things appropriately, these details matter. And even if you're trying to do things quickly, right? Whenever you do things quickly and rushed, that's when the problems arise. They may not rise immediately, right? But they're most likely going to rise down the road, and you're going to be more exposed. So these are just things that we're going to kind of discuss in greater detail as we go through this. Okay. Avoiding mistakes, right? Possible risks. And we kind of just briefly went over that. Premature distributions may violate legal or tax requirements. Okay. A big example of this is, let's say your family member's trust says that I'll use myself and my brother. I like to, because this is a simple scenario because there's only two of us. Okay. Let's say my parents' trust says that both of our shares, we're 50-50 beneficiaries, but both of our shares are held in trust for our lifetime, right? And my brother goes, hey, look, I had this health expense come up. I need some funds. And I say, sure, I'm the trustee. I have the authority to make distributions. I'm going to give you these funds. And I give him the funds. I write him a check to my brother. His name is Lee. And I put, Lee, here's your $10,000 check. Go do what you need to do, right? But I just violated the term of my trust. And a lot of people go, well, wait a second. Isn't he the beneficiary? No, it says his share is held in trust, which means there is a trust fund. Now, there are a whole bunch of different names for this. You may have heard it as a separate share trust, a sub trust, lifetime trust, descendants trust, GST trust, child trust, you name it. They're all the same thing. Okay. They're just fancy terms that estate planners like to use for a trust fund. And what if his trust fund says that Wells Fargo is the trustee of his trust fund? So I, one, didn't set up this trust fund. Two, I didn't distribute the funds to Wells Fargo, who's going to be managing his share. And three, I made a direct distribution to the beneficiary. And what if his subtrust says I can't do that? What if his subtrust says only for maintenance or only for education? Right? I just violated so many aspects of the trust, even though ethically and morally I did the right thing. And that's where a lot of people have issues with these distribution phase and the distribution process, and sometimes where the beneficiaries also don't understand. Right? Whereas from a moral, spiritual, ethical standpoint, I did what was right. But from a legal standpoint, from a tax standpoint, from the trust standpoint, I couldn't have violated it more. Right? I did everything inappropriately, even though that's in stark contrast with the other areas of our existence, right? So making sure that you're doing that appropriately is huge. And then not only making sure you're in compliance with those things, but articulating and communicating with the beneficiaries to advise them of that, to basically say, hey, I can only do this, or I'm not the appropriate party. It's Wells Fargo who's going to be the trustee of your share. They're going to be the ones managing it. You need to submit your request to them. Now, there are ways to expedite that to make sure that my brother is provided for in a more timely manner, of course, but always run that by the attorney first before making that decision. Okay, it's much easier to walk you through the pros, the cons, the options that you have rather than trying to claw back an inappropriate distribution. Okay. Incomplete or missing financial records can undermine trust accountings. So I'm going to go into trust accountings a little bit further, but if you do not provide all of the necessary financials to the attorney, they cannot give you complete advice. I have had clients on numerous occasions give us the financial information they think is important. And then we do final distribution schedules, we do waivers of account, we do final receipts, we do informal or formal accountings based on this information. And if you are not providing, the trustee is not providing the entire picture, then what we are advising you is incomplete and therefore incorrect, and therefore exposes the you as trustee and the trust. So providing complete and accurate financial information, and you, the trustee, not making a determination on what is or isn't appropriate, right? The trustee will have that discussion with you. You may provide financial information that you ultimately don't have to provide to the beneficiaries for one reason or another. But you need to have that conversation so the attorney can tell you that you don't have to disseminate, aspects A, B, and C, but D through Z, you do have to disseminate. Okay. So making sure you're providing complete, thorough, and accurate financial records will only protect you as trustee. And anytime you're protecting yourself as trustee, you're protecting the trust. And if you're protecting the trust, you are protecting the beneficiaries. Whether they see that or not is a completely different conversation, but that's ultimately the best case scenario. And then finally, missed tax obligations can create penalties. Okay. So this is kind of straightforward, right? Missing filing deadlines, missing tax liability payments, not filing final individual and final trust income tax returns, not filing all of the trust income tax returns if there's multiple subtrusts, if your parents or loved ones had an AB or an ABC trust, or if they had other standalone trusts, if they had a gift trust that they created, or a Prop 19 trust, or they had inherited a trust from another family member, right? Making sure that you're finalizing all the appropriate tax returns, including an estate tax return. If they had a larger estate, or it's a first spouse who has passed away and they need to file a federal estate tax return, making sure that's done timely and appropriately to negate interest, to negate penalties. And also, again, same thing I said a little while ago, maximizing tax benefits where we can, right? Which is a tax reduction procedure, and having these conversations early and often only increases the likelihood of tax reduction. Not tax elimination, right? We can never eliminate taxes, but we can reduce in numerous instances. Okay. Errors may expose trustees to personal responsibility. Potential legal challenges, beneficiaries may question or contest trustee actions. So, in instances where the trustee commits malfeasance, sometimes they can be held personally liable, even though they're acting as trustee of the trust, right, which is a fiduciary capacity. And in most instances, their conduct is covered by the trust. In certain instances, they can be held personally liable. And if a beneficiary or third party brings an action and they're successful and personal liability is attributed to the trustee, that beneficiary or third party can now put a lien on your personal assets, put a lien on your house, put a lien on your bank accounts, put a garnish wages potentially, right? So there's a lot of things that you have to be aware of, and you do not want to be doing anything that's going to expose you personally, which can become with heavy ramifications. I have a matter that I'm working with another law firm who's taken the lead on the litigation aspect, and they had secured there are multiple parties involved, and ultimately the one co-trustee was able to secure a whole very long judgment against the other co-trustee for years of abuse and years of inappropriate actions, and they ended up with a seven-figure personal surcharge against them. And that is a huge mistake that could have easily been avoided by the other co-trustee had they been following their fiduciary duties, had they administered the trust appropriately. They could have limited their liability significantly, if not avoided it in its entirety. So always be aware of that. Now, I will say this, even if you do everything correct, A to Z, start to finish, you are the perfect client. You're the perfect trustee. That doesn't mean you can avoid lawsuits. It doesn't mean you can stop someone else from filing something. And I think that's a point of contention, and a point of high stress and anxiety for trustees, is that a lot of times I'll be speaking with them and they'll say, well, I've done everything appropriately. I got served with this lawsuit. You know, what did you do wrong, Mark, or what did I do wrong? And the answer is neither of us did anything wrong. Both of us actually did everything right. We can't stop someone from filing a lawsuit, right? I today could go to court and file a lawsuit against every single one of you. Now, that doesn't mean I'm going to be successful, and it doesn't mean my lawsuit's going to survive, early objections or defenses, right? But what it does do is it means that I have all of the information, I have all the supports, and I have the record to show that I can easily defend against that lawsuit. And if you can easily defend the lawsuit, it just means less time, less money, less headache, but it does not avoid it completely, right? But it minimizes to the extent possible, and that's a huge benefit. Should you ever end up in litigation as in relation to your role as a trustee or in a trust that you've administered. Okay. Final timing, right? And how that works. So the trust governs when distributions occur. Okay, so a lot of times, you've done phase one, or you're wrapping up phase one, phase two, and phase three. The distribution phase is kind of at the end of the tunnel. You're starting to see the light, but beneficiaries are now really poking at you. They're really asking, "Hey, when are we getting our inheritance? When are we getting this? When is this we're wrapping up?" Right? And that always depends. The trust will govern that. Okay. And again, it depends on what the trust says as far as how the beneficiaries are getting it. Here's a great example. What if my parents, and again, I'm going to use my parents and my brother and I, what if my parents put in their trust that my brother and I are 50-50 beneficiaries? But if both him and I are under the age of 50, we receive nothing. Okay. And we don't receive anything until we turn 50 years of age. And what if we are only allowed to receive 10% at age 50? Right? So the trustee, even though, let's say the trustee has done everything, we're completely done with the basically phases one, phases two are done. We have all the distribution docs signed by myself and my brother, and we've both signed waivers of accounting, and we've both signed receipts. And the trustee is in the process of filing the tax returns, right? They've done everything that they're supposed to do by the trust and by California law, but no distributions can occur. Him and I are both not 50 years old, or rather, neither of us is 50, so neither of us can receive our share. And even if let's say I am 50, right? Even then, I could only, and I'm the trustee, I could only distribute 10% to myself because that's what the trust mandates. So you have to be aware of what the trust says. And a lot of times, once you understand that, and by this time, you should have reviewed that trust quite a few times and you've been working on that trust administration, so you should know and have a decent idea. Or if you don't, you should be having a conversation with the trustee to have a better idea of what that looks like. And then you can articulate that to the beneficiaries. I'm going to my brother and saying, hey, look, mom and dad created the trust this way. We can't get distributions until we each turn 50 years old. Right. Or the trust could say something to the line of to the effect of, we're only entitled to income, right? We can't touch the principal. So I go to him and I say, look, the trust is very specific. We can't get any principal distributions. So this $500,000 investment account, you or I are only entitled to the income. So any of the interest and dividends that it's earning, right? That's all we can distribute to ourselves for the next however many years, whatever the trust says, right? So it's making sure that you're following along with that, and then talking with the beneficiaries and making them aware of what that trust says, right? Now, let's use my same example. Let's say the trust says 50-50. There are no strings attached. It's not held in trust. It's outright free of trust, no age requirements. Him and I are both adults. We're not minors, right? At that time, I can go, hey, look, what I'm going to do is there's $1 million. We're 50-50. I'm going to distribute 400,000 to you, 400,000 to me. And I know that we sold some real estate, and I know that we're going to have some capital gains tax implications. So I'm holding back a reserve of 200,000 just to make sure that the trust doesn't have to pay any taxes, and if it does, we are covered. And I'm talking to him and saying, hey, look, once I get this final tax return filed, once I pay the taxes, I'll release most of this reserve. Right? Let's say I pay $50,000 in taxes. There's still $150,000 left in that reserve, and I go, hey, look, brother, I'm going to distribute 100,000. So I'm going to give you 50, me 50, and now the reserve only has 50, just for any miscellaneous expenses. And of course, these reserve numbers are completely hypothetical. It could be that you're only holding back a $5,000 reserve and not a 200,000. Okay. Or it could be that I've held back $1 million reserves, right? Just depending on the circumstances, the tax liability, the timing of that tax liability, any outstanding ongoing lawsuits, like personal lawsuits against your deceased loved one or against the trust itself, right? Or if there's issues with tenants and you're still trying to, whatever the case is, you're doing it appropriately and you're following the trust. Okay. I think that I've covered the next three items here, kind of along with that analysis, right? Debts, expenses, and obligations addressed before distributions, right? You want to have an idea with your financial planner, with your CPA, and with your trust attorney, talking about what those look like, if any remain, holding back enough to satisfy those, and getting and relying on the CPA to get projected tax liability, right? And then, of course, you're holding back, a little bit more than you actually anticipate. So if you anticipate $20,000 in what we'll call closing expenses, and that's debts, closing expenses, trust closing expenses, taxes, outstanding obligations, right? You're not going to hold back 20. You're probably going to hold back 30 or 40 just to be safe. Okay. And then you are releasing that reserve in an appropriate, reasonable manner, unless the trust says otherwise. right? If the trust says you have a specific time to release that reserve, then you want to follow that the trust mandate, unless it's not reasonable, practical, or feasible when you're talking to the attorney. Most of the time, it does not say that type of language. Okay, so you're holding that reserve for an appropriate time. What that appropriate time is, different case by case. I've had people release that reserve just because of the circumstances within a couple of months. I've had people withhold that reserve and release it within 6 months, 9 months, 12 months, 18 months, 3 years. Okay. It just depends on the circumstances. And of course, that doesn't mean you can't reduce the reserve. Let's say it is appropriate to hold it for a year or two. That doesn't mean you're not reducing it when appropriate, or if it's actually you're able to reduce it, right? Like in my example where I hold back 200,000, I paid the tax liability. I know that there's no other obligations and debts. I've sent, I made a distribution to my brother and I'm still holding back 50. And then maybe in a couple of months, I distribute another 25,000, and another couple of months, I distribute the remainder, right? That's just one example. Then another example, I could hold back 10,000. I've already dealt with all the obligations. I hold it for 6 months just to make sure there's no miscellaneous trickle hospital bills that come down the line, or cemetery, mortuary, or credit card bills. I'm just waiting an extra 6 months. 6 months comes and goes. I release the entire reserve, right? So it's really just case by case, but making sure that you're accounting for all that, okay? Because if you're accounting for all of that, that means once you do release it, right, you release the reserve and the beneficiaries have all signed all the appropriate documents, you're minimizing or potentially completely eliminating and negating any potential future liability. Right? You've basically crossed the list off. You've crossed all the tax returns, tax liability, final expenses, beneficiary exposure. You're really wrapping it up and making it nice for yourself. And timing matters. As you can see, timing will affect all of those things. So making sure that you're discussing with the attorney, giving them all the information they need, they can properly advise you on the best course of action forward, or your different options, right? Sometimes it's you have a multitude of options to choose, and you as trustee will make the appropriate determination based on your particular circumstances. And then lastly, but not least, clear communication with the beneficiaries helps prevent confusion or conflict. Okay, this is key, right? I'm going to go back to my example. My parents' trust says my brother and I don't get a single dime until we are 50 years old, right? Not both of us having to be 50, but just as I get 50, I can receive 10% of my share, and he gets to 50, he can get 10%. Okay. And it's a strict interpretation of that particular provision. There is no discretionary language anywhere in the trust that says I can go outside those bounds, right? So I am required, I am mandated to follow that provision and be very strict with it. Even if my heartstrings are being tugged because I know my brother has a health cost that he needs to cover, right? I am having and I am required to follow that to comply with California law. Clear communication, telling him that, saying, hey, look, my hands are tied. I don't really have any way around this. However, maybe I can go talk to the trust attorney, and maybe they have some solutions, right? So you're not making that decision. You're not violating the trust. You meet with me or another estate administration attorney, and I'm going, oh, okay. Well, look, it's just you and him. When I'm talking about you and him, myself and my brother, maybe we can petition the court, right? Maybe we could petition the court to approve of an action that would normally violate the trust, right? And in that instance, we're finding a legal workaround. You're not violating the trust, you're not violating your duties, but we're also helping him out, even though, excuse me, it's outside the bounds of what you're actually allowed and what the trust actually specifies. Okay. But clearly communicating with the beneficiaries is huge. Now, I will say this. I have met with a plethora of people over the years, and communicating with those beneficiaries isn't always easy, right? Whether it's siblings or extended family you haven't talked to for a while, or family members who have kind of abandoned the family or have kind of separated themselves, or potentially it's beneficiaries who don't have capacity to represent themselves or to be able to communicate appropriately or thoroughly in this example. So helping, talking to the attorney about how to handle that, right? And in some instances, it's the attorney reaching out to those beneficiaries and saying, hey, I haven't had a relationship with this person in 20, 30 years. Can you be the in-between? Absolutely, right? But at least someone is being designated to articulate and pass on this information, okay? And a lot of times, I can't tell you how many times I have trustees doing a phenomenal job phenomenal job. They're doing everything they're supposed to do and they're doing it timely, but it still takes time. Even if they do everything, even if they're a rock star trustee, trust administration can still take on average 6 to 12 months on average, right? A lot of them can take much longer. And if you're not communicating, right, the beneficiaries will start to build up concerns. They may already have resentment, and now the resentment is being justified, right? Even though you're doing everything appropriately, you're crossing the T's and you're dotting the I's. They are starting to get concerned, and when they get concerned, right, that's when the contentious nature starts. That's when they would be more inclined to go get an attorney and maybe even bypass initial communication with the attorney. A lot of times, beneficiaries go hire litigators, which is worst case scenario because a lot of litigators have never handled an estate administration and have never drafted an estate plan. And they just go run to the court and file an action, right? Whereas a lot of times, I've worked with a lot of estate administration attorneys at other firms, and a beneficiary will hire them, and they will do the appropriate thing. They reach out to me, we have dialogue, we open up that communication, that channel, and a lot of things can move forward a lot more swimmingly, a lot more efficiently, and a lot less cost to the parties. So trying to avoid that when possible. Best case scenario, not 100% always avoidable, but as you can see, there's a lot of things you can do to try to mitigate that. Okay. Um, Continued final timing. Okay. Financial transparency. Accountings should clearly reflect all appropriate transactions. Okay. Beneficiaries should understand how figures are calculated. Reports must promote transparency and trust, and you prepare to respond to reasonable inquiries and provide supporting documentation. So, a trustee, one of your duties is you have to provide a formal trust accounting. And when I say formal trust accounting, what that means under California law is it is in a court mandated specified format. A lot of times CPAs will say, oh yeah, we do these accountings all the time. And usually, I hate to say this, it's usually a flat out lie. They don't. They will do it in what is considered your standard, I forget the acronym for the accounting, the general accepted accounting principles, or they do it in some standard corporate quarterly financial report format. A lot of times, by the way, those are actually easier to read and digest than this court mandated format. But nevertheless, it has to be in that court mandated format because none of the statute of limitations will start if you provide a non-approved court mandated format. It's almost it doesn't maximize protection to you. Now that doesn't mean we don't provide those other types of accountings, but there are specific instances when that would arise. Okay. Now, again, we're trying to avoid the accounting altogether. Normally, it's prepared by an attorney's office, and it is an expensive and time-consuming process. Right? A lot of times, we're trying to get the beneficiaries to sign waivers of account. Now, that doesn't mean they're not entitled. A lot of times beneficiaries will come back and say, well, I don't want to sign this formal waiver of accounting, right? You didn't give me any information. And that's perfectly normal and expected, right? So if all of them do not sign that waiver of accounting, before we go rush to do the formal accounting or rush to go file it with the court, what we're going to do is say, okay, what information do you need, beneficiary? And we can provide you with that a lot of times, either free or at a reduced cost, right? Because the trustee already has all the financial information and they can say, hey, here are copies of all the bank statements. Here's a copy of the valuation reports. Here's a copy of the closing statement for the sale of the house. Here's a copy of the estate sale and the proceeds. Or in a lot of times, here's what we actually ended up paying for the estate sale. We didn't actually, we were in a negative after that. And here's a copy of, my cost reimbursement because I came out of pocket for these things. You can give a lot of that information to the beneficiary, and now they feel comfortable to sign that waiver, right? So there's things you can do to kind of avoid this formal accounting, but nevertheless, there are a lot of times where the beneficiaries or even one beneficiary will not sign that waiver regardless of what you do, right? And you are forced to then prepare and serve this formal accounting. A lot of times, you don't have to file that formal accounting with the court, but it is an option. There are numerous times where we know, right, just based on the communication with this individual over the lifespan of the administration, that they are not going to comply and they're going to be combative regardless of what type of information you give them. And in those cases, we file that formal accounting with the court and we get the court to sign off on it, right? So there are ways to move this forward no matter what. But as you can tell, that will significantly affect when distributions are going to occur. If we do not have signed waivers, we do not have signed receipts, and we have issues as far as transparency or beneficiaries uh, indicating some that you've done some malfeasance or you've inappropriately managed or you committed some type of action or conduct that you didn't have the power to do, right? We're walking you through this report process, is the preparation of this formal accounting, we're preparing it ourselves, and what the best next step is. Okay. But regardless, if you are preparing that formal accounting, or we're doing that rather, right, we need to clearly reflect all the appropriate transactions, right? So having the legally required information, the data, the expense, the party it was paid to, the amount, the purpose, and so on, right? Appropriately demonstrating here are the sales of all the stocks that occurred. Here was the basis. Here was the sale price. Here's the gain or loss, right? All of the appropriate information. And again, the beneficiary should understand how figures are calculated. Sometimes in these court mandated formats, it's not very clear, and that's something that neither you or us can avoid. But hopefully, when they come back and say, hey, can you give me a little bit more information on this particular transaction? You have the support to say, hey, here it is anyway, and it's cleared up. Okay. Um, so yeah, a lot of times, and then also what assets to include on that formal accounting are also imperative. Okay. So talking to the attorneys about which assets need to be reflected and which do not need to be reflected. And then in some instances, sometimes assets that do not need to be reflected are being put on there for transparency purposes anyways. Okay. So these are all very important aspects to understand. And just know that if you're a named successor trustee, you may have to prepare this formal accounting. Of course, the formal accounting is covered by the trust itself. So you as trustee or successor trustee do not have to come out of your personal pocket to pay for this. It is a appropriate trust expense, and so the trust would cover it. But right, as you well know, if we're having to prepare that formal accounting, that's going to reduce the amount of funds available for distribution. So that's also a conversation to be had with the beneficiaries to say, hey, is there information I can get you that I already have or can get quite easily without having to prepare this formal accounting to induce you or to make you feel more comfortable signing the release, the final receipt, and the waiver of accounting. Okay, limiting future liability. So you've kind of heard me say all these things already, right? You've heard me use these key words, and now we're at the final time when we're ready to do this. So in the distribution process, when we're in phase 3, okay, the first thing that we normally do is a distribution schedule. And the distribution schedule usually just goes to the trustee because we're asking the trustee, hey, you provided us all these date of death values 14 months ago. We now need to know, and you've now closed accounts, consolidated, and sold assets. We need to now know what the current assets are as of February 1st, 2026, so that we have an idea of what the current account balances are, and then also to have a discussion about what an appropriate reserve is, whether you're taking trustee compensation, are there outstanding cost reimbursements that need to be paid, and we're finalizing the distribution schedule so that we have a really solid understanding of the next part of that distribution process, which is sending the beneficiaries all of the information that they need, right? Sending final receipts to the beneficiaries, basically acknowledging that they're receiving these assets or this amount of funds, and releasing you as trustee for all your actions, sending that waiver of accounting if everyone's on board with waiving the formal accounting, that is, and then also sending them information on how to receive their distribution. Let's go back to the example of my parents and my brother and I. Let's say they said that our 2 shares are outright free of trust. I know that at that point, once everyone signed the distribution schedule and the receipts, the waivers, everything's been buttoned up. I now know that I'm going to hold back, that reserve in the trust account, and then I'm going to cut a check to myself and my brother in our individual names, right? I'm going to say Mark O'Brien. I'm going to put Mark O'Brien as trustee, writes this check to Mark O'Brien, as an individual, right? And then I receive that and I deposit that into my own personal accounts. Now let's change the scenario. Let's say it says my brother's share, my share's outright, but my brother's share is held in trust indefinitely, and Wells Fargo is the trustee of his share, right? So after I hold back that reserve, I'm gonna cut myself a check to my individual name. I'm gonna deposit that into my account, okay? But my parents know that my brother, um, you know, is financially incapable of managing his inheritance, right? So to protect his inheritance, we are having a corporate fiduciary manage it for him. And basically, from there on, once it's funded, he will be in, constant communication with Wells Fargo saying, hey, I need the funds for these purposes. And Wells Fargo will go, okay, the trust says those are all authorized. Here you go. Or Wells Fargo will make the payment directly to the third party on his behalf, right? But in that instance, I am not writing a check to my brother in his individual name. I am sending Wells Fargo in this instance, right, the necessary paperwork to set up that trust fund. And then ultimately, I'm writing a check or wiring funds to that new account that Wells Fargo has set up on behalf of my brother, right? And for example, it would be something to the akin of Wells Fargo trustee. My brother's name is Lee, to the Lee O'Brien, lifetime trust or GST trust, whatever the name is. Excuse me. Okay, so I'm doing it appropriately, and I'm sending the beneficiaries. Now, change the scenario just a tiny bit. What if the trust says, well, my brother is the trustee of his share? Okay, so I'm cutting a check to myself as an individual, but I'm now sending him paperwork and saying, hey, here's the documents you need to review, sign, notarize. Once that's done, we're going to get you a tax ID number. We're going to give it to you, and we're giving them the instructions for this. And we're saying, now that you have everything, go to a bank, go to a financial institution, open up an account, and we're giving you, all this information in the name of your trust, and then we will write a check to him as trustee of his trust or wire transfer those funds into his newly established account. Okay, so making sure you're doing this appropriately. Like I said, approval documents validate the trustee actions. So those receipts, the releases, the waivers, those all absolve the trustee of liability because they all say basically, I'm acknowledging that this is the appropriate amount I should receive. I'm releasing you of liability. I consent to all of your actions through the period of the trust administration, and I'm waiving a formal accounting for the period of trust administration. And then you're appropriately sending all the appropriate documents to help them actually receive that distribution. Okay. And then, records confirm when and how assets were transferred. Of course, we're sending cover letters that will be saved in the file and provided so that you have a record that you provided him in this instance with all the documents he needs to go open it up. You're keeping a copy of the canceled check that you actually sent to him and a copy of the bank deposit record showing that he deposited it on his end. Or if it's a wire transfer, you're keeping proof of that electronic transfer just in your files so that no one can ever come back and say, hey, I didn't receive this, right? So if they have a signed receipt and you have the proof from the bank that he cashed that check into that account, it's going to be very hard for him to come back 5 years later and say, I never received my $300,000 from my brother, right, as trustee. I'm going to go meet with the attorney and file a lawsuit. Okay. But I have all this paperwork that he signed, that his bank's acknowledged receipt, and then my bank acknowledged receipt. It's going to be very, very, very hard for him to make a claim of that nature. And then, whoops, skipped ahead. Proper documentation helps limit future claims. I think that just goes kind of along with everything that I've been discussing on this particular slide. And then the final wrap up, closing matters. Again, these are kind of more just reiteration of what we talked about, right? Final tax filings are coordinated, prepared, and submitted. And along with that, right, any tax liability paid or provided for in some manner. Professional advisors are consulted, and it's a team. A lot of times it's a team. It's the trust attorney who's helping you with the estate administration. It's the CPA and it's the financial advisor, or potentially even it's not a financial advisor, but it's the financial institution that's holding the funds. No one's going to keep it at that particular institution, but you still need to have communication with them and coincide that teamwork together to make sure that when they are releasing those assets, it's done appropriately. And then finally, basically, I'm going to skip to the reserves established, right? Your reserve is established. We've been kind of talking about that throughout the entirety of this webinar. But let's say you've already dealt with everything and you're releasing the reserve. At that point, right, you're closing the financial trust account. Once all of the obligations have been met and you've released that reserve, you're terminating that trust account. And basically, once you have released that reserve account, all taxes have been filed and paid. All funds have been distributed, liquidated, or transferred in kind to the beneficiaries. They've all signed their documents. They've signed or approved an accounting. They've waived the accounting, whatever the case is. Real estate has been transferred. Business interests have been sold or transferred to the appropriate beneficiaries or parties, right? At that point, we're really wrapping up and we're winding down and we're closing it. And at that point, your role as trustee will subside, right? If this was actually a probate, you'd be filing a document that says what's called an ex parte discharge. Even after the probate's completely done and you filed the final order and the final receipts, you file something with the court that says, hey, court, relieve me as the administrator or executor of this estate and discharge me of those liabilities, right? And that cuts off your role as a fiduciary and it cuts off your continuing liability and responsibility. Same thing here. You just don't have to file anything with the court. You're just closing the final accounts, buttoning up your records, filing them away in a secure place so you can have them for a little while. Keeping PDF records of everything. That's probably best to have, on your laptop, have the records, have a flash drive, and have a physical file. That way you're covering all of your bases. Okay. Path to closure, right? Any unresolved matters clearly identified. We are clearly doing this as a part of that distribution process, right? This is not something you're doing after you've made distributions, after you've done, tax returns and released that reserve. This is all part of that phase 3 distribution process. Potential conflicts are handled, right? If there's a lawsuit, that has to be handled before you make distributions. If there is a tax claim or you're in tax court and you're fighting with the IRS about something, right, you're dealing with that before closing. If you're dealing with the property assessment or a capital gains issue, you're doing all of that or some type of estate or trust audit. All of those things are being dealt with before final distributions. All required paperwork is finalized. So we've talked about that, right? The distribution schedule, the final receipts, the releases, the waivers of account, or a formal accounting and account declaration approvals or a court order approving that accounting. The trust income tax return is filed. The tax liability has been paid and you have proof from the IRS that you've made a complete payment and there's no other liability, right? All of that has been finalized. As you can see, compliance with all of those and confirming the finality of each of those aspects will ensure that all of your legal duties have been satisfied, and that will protect you from any liability in the future. And like I said, we can't stop anyone from filing a lawsuit, but it sure as heck can help you defend it in a much more streamlined process. Okay. And then closing the trust, final steps. So trust administration duties fulfilled. We've talked about a lot of what those are. The required legal and procedural steps completed, no unresolved obligations, and the trust administration officially comes to an end, right? And a lot of times people will say, what does that time frame look like? And it's really hard to ballpark because each matter is so different. I could have a matter here that my parents could have one house, one bank, and your parents could have, or your loved one or family could have one house and one bank account, and they could be just so diametrically opposed administrations requiring so many different things, where this administration took 6 months and this one took 2.5 years, right? So when I say it comes to an end, it's a very, very, very wide spectrum on what that looks like. But of course, if you're doing everything appropriately, hopefully that expedites that and hopefully allows for distribution in a more timely, efficient manner, which again, beneficiaries are only going to be happy about expedited administration if possible. And when I say expedited, I don't mean, within a month or two, although they would, unfortunately, some beneficiaries show up at the day of the wedding. I'm sorry, wedding, a funeral, asking for their inheritance, right? So those are things that do happen more often than I would like to hear, but it does happen. But just making sure you're communicating, setting those safeguards, setting the boundaries, setting expectations really helps as you progress through this process. Grief, I like to say grief and greed are a crazy combination, right? Very crazy combination, and very unpredictable on how someone is going to act. Even if it's someone you have known for 40, 50 years and they have been this way for those 40, 50 years, and now all of a sudden they've changed significantly. Being ready for that, being prepared, establishing safeguards, fulfilling your trustee duties, doing everything in a timely, appropriate manner, following the trust, fulfilling your trustee duties, right, will help move that process forward. Okay. And we're obviously here to help you do that and make sure you're not doing this without proper guidance and oversight, both from a tax and legal standpoint. Okay. Like I said, this is kind of what I should have actually went forward on this slide because it's everything I just covered. The legal guidance helps maintain structure and clarity. Attorneys help trustees follow California law. Or conversely, if the trust, sometimes people move and they come back to us because they go, you guys did our parents or our family members' trust, and they went and redid the trust. They moved to New York and they redid the trust in New York, and all the assets are in New York. They come to us, we review it, and we go, oh, hey, you got to go to a New York attorney, right? So making sure you're following the appropriate law is a big step, okay? Most of the time it's going to be California law if you're meeting with us, but nevertheless, professional oversight answers questions as they arise and provides you with some tools to be prepared for anticipated questions. And then lastly, trustees complete their duties with transparency and resolution. And we do the best, and you're going to do the best to do that. That's not always 100% feasible, but the more you can get it close to 100%, the better the outcome. Okay. Um, that's kind of it for today. I know I gave you a ton of information. Always, reach out to us. We will walk you through that process. Like I said, each case is variable. If you have questions on anything that we talked about today, please keep throwing them in the chat because our marketing team will take them. They'll send me the questions. And if they're not too nuanced, like I said at the beginning, we'll definitely try to get a response to you or advise you to, hey, reach out to schedule a meeting with an estate administration attorney or or you may need to schedule an appointment with our litigation department, right? If something's already come up and it requires litigation analysis, you can schedule a consult with them or even our estate planning department, right? If you just want to go over your trust and kind of look at it and become more familiar with it and clear up any ambiguities or confusion or vague terms that you want to understand better, please feel free to reach out. Next steps, these are kind of just some vague overview things to be aware of, right? Meet the deadlines, protect the assets. Ultimately, both of those things will reduce liability, get the trusted tools and guidance for every trustee duty, ensure compliance with all legal requirements, and stay compliant, prevent disputes, and document every step, right? Those are just I know those are from some very general tips and terms of advice, but really, sometimes it's the most basic, foundational, fundamental things that will save you and protect the trust and the beneficiaries in the long run. Okay. Lastly, these are just some closing items that if you've seen any of our webinars, been to any of our seminars, you've kind of seen this same slide for quite some time. We've been open for almost coming up on close to six decades, actually. Or sorry, 5 decades. We have numerous attorneys. We have hundreds of years of combined experience. We have advanced tax degrees, LLMs in tax. We also may have we have accountants and CPAs. We have certified specialists in probate, estate planning, and trust law. Numerous locations, can meet with you in person, email, phone, Zoom, a lot of different capability to serve your needs. And then lastly, the contact us landing page, please. These are all of our contact information. Most importantly, see the last item, digital evaluation. Please complete this. I was told by our marketing department that the last year we had a ton of engagement from our clients filling out that digital evaluation. So we want to continue that progress in this year. Why? Because it gives us more topics to talk about in these webinars. So the more you feed that, fill that out, the more of you that provide that, we can see that, oh, wow, 100 of you asked about the same exact item. Is that something we can put into a webinar or do a seminar on? So please fill that out. Also, rate me, grade me, right? Tell me how I've been doing. I encourage the constructive criticism and feedback, anything I can do to increase my ability to articulate this information, to provide it to you in a digestible, feasible, appropriate format. I encourage it and welcome it. Or if you want to tell me I did a fantastic job, I will also accept that as well. But either way, give us your feedback. Let us know how we're doing and let us know if there's anything in the future that you'd like us to touch on. And maybe kind of what we did here, maybe we can turn it into a multi-part series, which just allows me to give you even more information. Okay, so I'm going to leave it on here at this point. The webinar is concluded. It's been a pleasure speaking with all of you today. I hope this was a good tool for you and that you gained a lot of information and insight. And I look forward to either meeting with you or speaking and presenting in the future. Once again, Appreciate you taking the time out of, I know all of our schedules are extremely busy. Appreciate you taking the time to meet with us, and have a great rest of your day, great rest of your week, great rest of your February. And again, once again, thank you for taking the time to be here and to give us some feedback. Otherwise, all of you take care, okay? Bye-bye.